Hi there, welcome to my four-part series, Becoming Warren Buffett, part two. I am Richard Harrington and I'm an investor and a philanthropist. But before I begin part two, I just want to share a story of a friend of mine that emailed me when the whole COVID-19 broke out. And he's like, Richard, they closed the US markets now for the second day in a week. Aren't you worried? And I said, you know what, a real investor isn't worried if they close the stock market for 5 years, because is in it for the long term. In fact, Warren Buffett says if you can't hold a share, if you can't see yourself holding the share for 10 years, don't even buy it. So it's all about playing the long game. So there's a few shares I hold for 10 years, but most of my shares I hold from 6 to 12 months. So whereas a trader buys and sells shares every day, an investor buys and holds. So I buy and hold my share for minimum 6 months. I don't sell my share before the 6-month period. And as many of you guys know, I live off my shares. I'm financially free, so my asset supports my lifestyle. I don't need a job. So I just hold the share for 6 months and I sell it, and I take the profits to sustain my lifestyle and I reinvest the capital, because the capital is my seed. And I tell people, never eat your seed, because many people live month to month to month because they eat their seed. Your seed is what you carry over. And that's what we spoke about in part one, that it is assets that build wealth, not stimulation. So many people, like your traders, they want to be stimulated every day, when to buy, when to sell. No, it is assets that build wealth. So we're not concerned if they close the stock market for 5 years. We bought that share with the longer term mindset. And as you know, from the part one I spoke about, it is all about building asset income and reducing active income. And if you're thinking, Richard, what are you talking about? You need to go back and watch video number one, because assets is the name of the game, and there's basically four main assets. It's your stocks, your real estate, businesses which you own, and you invest in yourself as an asset, and it is assets that build wealth. But for part two, I want to speak about how to evaluate a good business. Yes, a good business, because Warren Buffett looks at the stock market as a collection of businesses. So it is not about the price of the shares. So many people are like, oh Richard, this shares was $10, it's now $15 dollars, it went up by 50%, must I buy? Looking at the share price is not investing. Evaluating the business, that's investing. Because when you buy a share, you're owning a part of those businesses, and your share portfolio is a collection of businesses. And I thought for part two, I want to share the three main things I look at before I invest in a business. It's the three main things Warren Buffett looks at before he invests in a business. And the question that we want to ask is, how do we value a good business? Because many times people say, oh, the share, I dropped, must I buy it? You need to evaluate that share. So there's three main things we look at. If you guys have a pen, notepad, iPad, you want to take it down, you want to write this down. Number one, you are looking at the cash flow of the business. The goal of business is not to make money, it's to make a profit. If you have a business that break even for more than 2 to 3 years, it won't be surviving, because the goal of business is not to make money, it's to make profit. But many people say they have a business, but if you're not making money, it's not a business, it's a hobby. So what's my point? You gotta have cash flow. Many businesses fail because they run out of cash. You gotta have cash flow. So when you're evaluating a business, you're looking at what is the cash flow running through this business, and you get that from the cash flow statement, the balance sheets, income statement. Numbers don't lie. You have to do your research. Many people buy businesses and then they just open the books and they bought debt because they didn't value what they were investing in. So you want to look at the numbers. Is this business profitable. Look at the balance sheets. So you can tell an investor 5 years from now we're going to expand into China, 10 years from now we're going to expand into India. That's great, but can I see your balance sheets? I need something tangible. I need to look at the numbers, because numbers don't lie. And the second thing you want to look at is a management team. This is everyone from your department managers to your CFO to your CEO to the board. You basically want to look at what is the track record of this management team, because you can have the best goods and services. If it's run by bad people, they'll run that business into the ground. So you want to look at the management team. Are they growth minded, and what are their success stories? And then number 3, you want to look at the business model. Is the business a growth model, or is it a defensive model? Is it a shrinking model? And the number one thing we're looking here, we're looking for earnings. What is the growth of this earnings? As Warren Buffett says, he doesn't invest in a business he doesn't understand. So you want to invest in businesses that are simple to understand. Businesses where your profits is 3 things. Your profits are sustainable, consistent, and predictable. And the more the business model is a growth model, the more sales they'll make, the more his earnings they'll make, and then over time the share price will increase. But the share price increases because it's a solid business model. And there was a journalist that asked Warren, "You didn't invest in the tech boom. You don't think you missed out?" Now bear in mind, Warren Buffett's worth $80 billion US, and the reporter asked Warren if he missed out. He says no, he didn't understand how to evaluate these high-tech companies, and he missed out. But needless to say, a few years later, the dot-com bubble burst, and all those people lost money, and his Warren Buffett still became wealthier and wealthier because he invested into solid businesses that he understands. So what's my whole point? You must be able to value the business before you buy the share. That is very important. And you value the business by looking at the balance sheets, looking at the management team, and looking at the cash flow model. Because looking at the price of shares, that's not investing, that is speculating. In fact, Warren says he doesn't even look at the price, because that might influence the way he values the share. So when you evaluate the business first, you can find out whether it is undervalued or it's overvalued. So the only time you look at the market price of the share is to find out whether the share is undervalued or is overvalued. And what does it mean if a share is undervalued? Basically, if you do your research, your fundamental analysis of the share, and you're like, according to my research, this share is worth $100 US. Then you look at the market price of the share. It is selling for $80 US. So I buy it because it's undervalued according to my research, based on the fundamentals. I don't buy it because of rumors or scandals or recession or crisis. I buy it because it is undervalued. And that's what you want to do. You want to look at your shares as businesses. And businesses, what are they producing? Like a farm, what is it producing? Not, if I buy the share for 10 US, maybe someone will buy the share for 15 US. Now you're trading the price, and that's not investing, that's speculating. And if you want to find out how to research your own shares and evaluate the company, I recorded a training, Advanced Investments 2.0. It's a 2-hour training where I go deep on how to do a fundamental analysis on shares yourself, and it's based on the Warren Buffett value investing model. And let's be honest, that's where Warren made all his billions. He knows how to value companies. So if that's what you're into, it's not for everyone, because it takes me four hours, sometimes 5 hours to research one company. But I love it. I love to look at what is the secret sauce of the company, what happens under the hood, what happens behind the curtain. So if that's what you're into, the link is at the bottom. You can buy the training and invest in yourself. And then the next video will be on part 3, and it will be about is how to become wealth. What do I mean by that? As you know, many people, they win the lotto, and 5 years later, or just even 1 year later, they're worse off. It's because they had money, but they still had a poverty mindset, a scarcity mindset. and it's about becoming wealth, not about having wealth. Because once you become it, then you radiate wealth. It's not, many people, if you don't become wealth, you can't hold on to it, and they have a good year and then a broke year, and a good year and a broke year. Once you become wealth, every year you just become wealthier and wealthier and wealthier. And that's what part 3 will be about, is how to become wealth. So I'm excited about that. If you love this video, share it with people that you think it will add value to. In the comment section you can write down stuff you learned. It will help other people, and I'm very excited of raising up new investors with a mindset to think for the long term, to play the long game. We're building wealth here, we're not making riches overnight. I really hope you got value, and this is Richard saying much love from the beautiful Bali. Bye for now. Cheers.